For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the economy checkup, what last week's reports tell us, what these reports mean for your retirement, the final 5 years before retirement, the most important countdown of your financial life, and then turning your retirement savings into a paycheck that you can't outlive. My name's Jeff Shade. As always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from Jake Floyd of Floyd Financial Group. Hey, Jake, how you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope everybody else is having a great August weekend. Hard to believe it. The 8th month of the year is upon us already. Kids are going to be heading back to school here before you know it, including Trevor. And I think we're going to get Trevor on the show here in the next couple of weeks to see what the young people are talking about as far as just the environment of the world and the environment of the country goes. So I'm looking forward to that. Jake, every week we're bombarded with headlines about inflation, jobs, the Federal Reserve. Last week was one of the busiest weeks of the summer for economic reports. Instead of just telling us what happened last week, let's help our listeners understand what these reports are really saying about the economy and why retirees should care. The headline was that economic growth slowed during the second quarter. Should retirees hear that and become concerned, do you think?
In my opinion, Jeff, no. I think the reasons why GDP slowed are more important. GDP is our gross domestic product, so it's basically all the productivity of the nation combined. It's also not a perfect indicator. It's not a perfect number. And when we're thinking about GDP and GDP growth, first of all, that number has been far to the upside of what any economist would have guessed or has thought was even possible over the last 2 years. The number keeps going up. They were thinking, we might have GDP growth of, we're going to be lucky if it's not negative. And so those numbers have continued to surprise to the upside. I do think that part of the reason GDP has been lower is the cost of fuel and things like that is stymieing a little bit the growth. As people know that are listening to this show, not too long ago, probably 5 months ago, we had gas in the city at select gas stations at $1.99 a gallon.
Yeah.
Those days are gone, my friend. And right now we're nearly double that in a lot of cases. When gas prices come back down, when diesel prices come back down, I think things will be better. We saw last week where Trump put out a big decree about these oil companies need to be lowering gas prices immediately or he's going to start making their lives difficult. So hopefully that'll get a little play around the globe here.
So, Jake, with gasoline prices, as you said, they were about half of what they are today, not that long ago. And we've mentioned before that when prices go up, they generally do not come down. Do you think that artificially oil companies are keeping these gas prices higher than what they need to be?
Of course. And I think that once they know we'll pay it, they tend to linger higher for longer. The gas prices shoot up as soon as oil shoots up, but then, oil's down 35% or something like that from the high, but gas prices are not. And so they're very quick to raise, not very quick to lower. Even though it hurts us locally in our pocketbook to have to fuel up, it's really much more important on the macro scale, on the global scale around the world, diesel fuel and things like that. So it does need to get down for a lot of reasons, including the average person's pocketbook when they go to fill up. It wasn't too long ago that it was, $50 or $60 to fill up the truck. Now it's $100.
Oh, yeah.
I think a lot of people are looking forward to those numbers coming down. I think Trump and others are very focused on bringing them down. So we'll see how much influence he has with these oil companies.
Well, America runs on oil, and certainly there's a trickle-down effect. Certainly when gasoline prices and diesel prices are up like that, the cost of everything else tends to go up because, of course, all those goods need to be delivered to us, and many of them run on oil. Let's get back to the GDP a little bit here. Jake, why do Wall Street and economists spend so much time talking about the gross domestic product?
Well, overall, it's probably the easiest measure to see how they think the economy is growing or slowing. Having GDP growth coming down is one thing. Having GDP coming down is another thing. It's a little bit like inflation. If the inflation rate, meaning the change year over year, is coming down, that does not mean prices are coming down. It means we have less inflation going up than we had before. In the same way, GDP growth that's also true. So if we have GDP of 30 trillion, let's say, and then we go to 33 trillion, that's a 10% increase. And then if the next year we go to 35 trillion, that's a much slower rate of growth. However, GDP is not negative, right? Those are two different things. So I think we have a massive, massive economy, and it's still growing very healthily. People are still spending. I'm much more worried about consumer habits and what people are spending money on and that they're spending money than I am the overall GDP numbers as a rule.
Talking with Jake Floyd at Floyd Financial Group, we're talking about the market and the economy and how it affects retirees and those people who are investing for retirement. Our phone number, 417-889-7233. If you would like the opportunity to come in and sit down and talk with Jake about these numbers and how they may or may not affect your journey towards a confident retirement, we're offering this Floyd Financial Group financial review. Absolutely no cost and no obligation. Again, to get yours, 417-889-7233. 7233. You can also find out more about us online at floydfinancialgroup.com. Jake, let's touch on inflation a little bit. Last I saw, it was just a hair under 4%. I remember it wasn't that long ago when our target goal was around 2% for inflation. Have we given up that? It seems to be so far away.
No, we have not given up on the 2%. In fact, I guess 10 days ago or so, Kevin Warsh gave a fairly lengthy talk, as well as took a lot of questions and things about the 2% target. He said not a whisper above. So I think 2% is still the number that we're trying to achieve. And 4% is not crazy, but if you get complacent at 4%, before you know it, you're at 5 or 6 or 7. So it's important to try to keep that under wraps as much as possible. I'm not a real big 2% hardline guy, meaning there's a lot of guys out there that think we need to be at 2 and that's all there is and that's all that matters. If we have an otherwise healthy economy and we're at 3 or 4, I don't think that that's really the end of the world. But I do think that Mr. Warsh is the right guy for the job.
All right, well, I want to talk about that Kevin Warsh a little bit here. How far you got to tote that Warsh, Kevin? Wall Street really doesn't like him very well, do they?
No, they don't. And a lot of the big money managers are very critical of his lack of transparency, and he said, hey, prior to the financial crisis, we didn't have the Fed interjecting every 5 seconds into the economy. We let free markets be free markets, and if we needed to get involved as the Fed, then we got involved. But since Bernanke, everybody has been hyper transparent and very loudmouthed and trying to move the market all the time, and everything they said, trying to do something to the market. And he said, hey, we're going to let the markets be the markets, and it's not my job to move the markets. The bond market will price in the degree to which bond yields need to change. It's not only up to the Fed to set interest rate policy. The bond market will set it as well. That's a tool in the Fed's tool chest, but when it comes to setting medium and long-term bond rates, the market has way more to do with that than the Fed. They can affect short-term rates, which in turn can affect long-term rates. But he said, hey, we're going to let markets do what they do. We're going to let free markets be free markets. One of the other things that I like about Kevin Warsh is one of the things that most of Capitol Hill doesn't seem to like about him is that he's a pretty wealthy guy. I think they said he's worth a couple $100 million or something like that. There's a couple things I like about that. Number one, I like the fact that he doesn't need to churn the office for money, because Bernanke was pretty well broke. Yellen was pretty well broke. Jay Powell had a little bit more wealth, but comparatively broke. So I like the fact that he's not going to be pressing his position to make himself money. Number two, I think if you're going to manage the money supply of the largest, wealthiest, and best nation in the history of mankind, you ought to have a little money so that you might have some idea what you're talking about. So I have no problem with him being a wealthy guy, but I think he's really on to something policy-wise to let free markets be free markets. And if he needs to get involved, he will. And we may see him raise interest rates a quarter point at the next meeting. We had 3 dissenters, but I feel much better with him in control. And I think that he really has a better handle on what's going on. he also knows that he doesn't know everything, and he's going to listen to what the market has to say to him rather than dictating what the market should think.
Jake, for American consumers, and I think most people listening to the program, when it comes to the Fed, they're only interested in interest rates, whether or not they're going to drop. And of course, with Jay Powell, we were looking for those to drop. They didn't. They held steady. There was some talk of even raising interest rates. Right now, for home loans, 6.75%. Interest rates on credit cards are still high. What can we expect from Kevin Warsh, do you think, in the near future? Are we going to get rates reduced? Do you think they're just going to stay the same? Or as you said, there's a possibility of even raising interest rates?
I think it's likely we're going to get at least one rate increase for quite a few reasons. I think the biggest reason, though, is just to show that he's not Trump's puppet and to kind of establish dominance, if you will, over the interest rate market. And I don't look to have more than 2 interest rate increases. I think if you get much higher than that, it's going to start to slow the economy down, and then they'll be panicking the other way. As far as timing on all this is pretty difficult to predict. I've been in the camp that interest rates would be coming down for quite a while, and I do still hold that position, but it could be a little longer than I was expecting it to be before they come down. As we've said before on the show, AI is deflationary in nature. So when that really gets into full swing and starts to lower the cost of goods that we buy and things like that, I think we're going to see deflationary pressures on the markets. And that should be generally a good thing for everybody involved. And I think we'll have lower interest rates at some point. But until then, the housing market's going to remain tight. Rent's going to remain high. There's a place in town here that does fully furnished apartments, and 1-bedroom apartment is $2,700 a month.
Wow.
In Springfield, Missouri, not San Francisco.
Yeah.
Here. Even like a studio apartment at the same place is like $2,000 a month. And there's lots of apartment places around that are $1,700 a month for 1-bedrooms and things like that. Now they have some amenities. They got pickleball and they got a coffee shop and all that. But I don't know that that's worth an extra $1,000 a month or whatever.
I don't think so, no.
I can drive down the street to the coffee shop.
Yeah, of course. And I think most people, these amenities are available to them. For the most part, they don't use them that much because you've got to be working a lot in order to afford a $2,700 a month rent. So I'm surprised here in the last bastion of sanity that rents have gotten that much.
Yeah, I mean, certainly not all rent is that high, but it just shows you a sign of what's happening. Now, again, that's a furnished apartment, but it's very hard to find anything to rent under $1,000 a month. And if you're making $25,000 a year and you earn less money, I mean, that doesn't leave a lot of room for dilly-dally.
No, it does not. Let's continue to talk about the Fed here just a little bit and talk about Kevin Warsh and interest rates. They affect almost everything, of course, mortgage rates, bond prices, CD yields, money market returns. This really creates some opportunities, these high interest rates, don't they?
It does, and certain investment types tend to thrive with higher interest rates, from fixed annuities, fixed indexed annuities to bonds. When you have interest rates going up, it tends to hurt metals and things like that. But historically, it's very good for annuities, really of all types, but certainly fixed index products where the underlying investment is bond yields, and we take that interest and use it to make more interest. So the higher that interest rate is, the more horsepower those products are going to have. And there's a lot of people in the market for safety as they get to retirement age and close to retirement age.
And I think there's a difference between savers and investors, people who are investing for retirement. Savers are earning meaningful income again. As you said, CD rates are attractive these days. Treasury securities remain attractive. Money markets continue paying competitive rates. But every opportunity should fit into an overall retirement strategy. So again, I'll remind folks that we're talking with Jake Floyd here, Floyd Financial Group, and we're talking about the market, the economy, all these reports that came out last week and how they may affect you and your journey towards a confident retirement. If you are wondering whether or not your retirement plan is built to handle times like these, well, you can get in and sit down and talk with Jake. Absolutely no cost, no obligation, no judgment. Will meet you where you are. It's called the Floyd Financial Group Financial Review. You can get yours absolutely no cost and no obligation. It's 417-889-7233. That's the telephone number, 417-889-7233. Again, a casual conversation, a chance for you to sit down one-on-one with Jake and talk about the things that are on your mind as far as your retirement goes. You can find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Jake, time for a break. When we come back, we're going to be continuing to talk about what the market and the economy has in store for us when Floyd Financial Group Show Me the Money continues right here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about what these reports, what this news really means for your retirement.
And Jake, last week there were a lot of reports that came out, and that's what we're unpacking today. And we talked about the economy, what it's telling us, and I want to shift gears. Let's talk about what retirees should actually do with all of this information. The markets still seem to be sort of on a rip or on a tear, Jake. Let's talk about that a little bit and what that means for our listeners.
Yeah, so last Tuesday we went to a new all-time high again, and we had been a little bit on pause since late April, let's say, where we went up a lot on the back of the decline for Iran, so markets went down. Then we shot back up, and then we've kind of been going sideways. So we just went to a new all-time high again last week. And when we've been talking about interest rate policy and the Federal Reserve and all that, part of the issue here is that there really isn't a big issue, meaning we are growing healthily. And anytime you're experiencing quite a bit of growth, you're going to have some inflation that comes with it. And so we don't want to kill that growth by raising interest rate policy too much. And I think that's what Kevin Warsh was really hinting at a couple of weeks ago. And he's just saying, hey, let's let markets do what markets do and determine the price of things, and let's stop leaning on it so hard. But I really think that this next 5 to 7 years should be very, very good in markets.
So, Jake, if the next 5 to 7 years are good in markets and people listening to the program right now are basically safety-oriented, they don't like the market, do you think that they should reconsider a little bit, even if they're in retirement? Are they leaving money on the table not being in the markets?
You know, I think that not everybody belongs in the stock market, so I don't want anybody taking that away from here. But I do think that most people can benefit from having at least a couple of different buckets of money. Maybe you're a CD person and you've always done CDs, maybe adding some money in the market or adding a little bit of money that's, again, we talked about fixed index annuities are really hopping right now. The rates are very good. In a fixed index annuity, you participate in market gains, but you do not lose money when the market goes down as a rule. Now, it's a little bit more complicated than that, but that's the basic idea is we get part of the gains, but none of the losses. That's something we can talk about in greater depth. I don't want to get on here and just talk about annuities all day, but I think that when we're looking at every retiree's portfolio, it's okay to have a little bit of complexity. We don't want to have just one thing. It's like when you go to dinner. Do you want to just have steak, or do you want to have steak with some mashed potatoes or some asparagus or a side salad, or do you want to just have a big steak and nothing else? Most people would like to have a little variety, and I think it's good to have a little variety, not only for a diversification standpoint, but also for diversification of strategy. When interest rates are high, CDs do really good. But anybody listening to this show that was invested in CDs from 2010 to 2022 will tell you that it wasn't quite the case back then, and you're getting 1/4 point interest on a 1-year CD. So one thing's not going to work 100% of the time, and that's why it's good to diversify strategy as well as diversifying your investments.
So these markets, they're at all-time highs right now. As you said, people look at this and they wonder whether or not they should be in the market. But is it a mistake to ignore the market completely and just concentrate on more safer investments, things like CDs and money markets, because they too are also enjoying some high-flying times right now?
It kind of depends on how you define a mistake. If you define a mistake as leaving money on the table, then it certainly has been a mistake for the last 130 years to not be invested in the market. I don't anticipate that that will change in the coming few years here. Now, again, when we get 10 years, 15 years down the road, I can't, that's a long time from now. I don't want to speculate as far as what's going on there. But as far as what we can see, companies are making more profit than they've ever made. Most of the big hyperscaling companies, the Amazons, the Metas, the Nvidias, that atmosphere, those companies are trading at lower multiples than they've ever traded at, meaning they are cheaper relative to how much money they're making than they've ever been, even though they're at all-time highs. So as profits continue to go up, we're going to see these stocks continue to go up. I think profit margins are widening and they're getting stronger and they're finding new ways of revenue in this AI revolution, if you will. And if profits and all that keep going, stocks are going to keep going. And I think there's a misconception of, hey, the market's at all-time highs, I should sell here. Well, the market's at all-time highs or near all-time highs like 60, 70% of the time. That's how you go to new highs. And that's how the market makes new ground. And so I kind of reject the notion that we're at the top here. I don't personally believe that's true. I think that we could see some volatility ahead of midterm elections and that kind of thing. But realistically, I think 2027 is likely to be a great year. I think the end of this year is likely to be good. We generally watch the S&P 500. I don't think 8,000 is out of the question this year either.
So, Jake, people equate the market with risk. It goes up, it goes down, and people don't like risk oftentimes when it comes to their retirement savings. Can you realistically have a good retirement with just focusing on safer investments and cash alternatives, CDs, money markets, treasuries, that sort of thing?
It kind of depends on your current income situation. You know, if you retired and you got a big pension and Social Security, and your spouse has a pension and Social Security, and you got $8,000 or $9,000 a month coming in guaranteed income, then yeah, you can probably just afford to keep everything safe and you don't have to take any risk and just keep your money at the bank. Now, most people don't live in that world. Most people have Social Security and then they have their 401k or something similar to that. And so we have to figure out how to make that 401k kick off income for them. And we have to make sure that they don't run out of money during their lifetime while they still need it. And in order to do that, we need to have some fairly healthy growth. And we can't just be at the mercy of whatever interest rates happen to be at the time. Because if you were retired and you were relying on that interest in 2015, let's say, that interest was basically zero. And so you were just spending your money. As you pointed out earlier, inflation's running 3.5%, 4%. If inflation's running 3.5%, 4%, and you're making even 3.5%, 4%, that means you're kind of staying stagnant. Your actual buying power is basically maintaining the same thing. You're not really making any ground. The market has been the greatest place to create wealth pretty much in the history of mankind. There's a few things that have made more money, like Bitcoin over certain periods, but that whole story is not over yet either. Bitcoin is certainly up millions of percent at this point, but short of things that we can see and touch and that kind of thing, the market's a good place to do that. There are ways to use the market to our benefit without having to directly invest in there too. So if you're somebody who's more risk averse, that's something we should talk about. There's ways to link your investments to the market without putting your money in harm's way. And so I think just harnessing the power of the S&P 500 is generally a good thing to do.
And Jake, we've talked about risk capacity versus risk tolerance. Risk capacity is how much risk that you could take, but tolerance is another thing. That is your emotional side of risk. And if you just can't sleep at night having too much risk, then your risk tolerance is probably low, and maybe you should stick with safe investments. Let's get back to talking about some of these reports. Of course, last week we got GDP. The markets are at an all-time high. We got all kinds of reports, and there are more to come here. Should investors be doing anything right now? When people hear these reports, a lot of investors feel that they should make changes immediately. Is that usually the right response or the wrong one?
Usually, knee-jerk reaction is not the right thing to do. It kind of depends on what report we're talking about. Anything we've talked about on this show so far, though, I think if anything is good reports. We definitely don't need to be running for the hills and being afraid that we're going to lose all our money and that kind of thing. Generally speaking, churning too much, going in and out and in and out and in and out is just going to cost you money. There's an old saying on Wall Street that says time in the market is more important than timing the market. It's also been pretty well proven that nobody can really time the market with any degree of success. So what we want to do is be an investor, not a gambler or a trader. So when we're investing, we want to invest in companies that we understand and companies that we can see and touch, places you shop. And we want to use what we know about those companies and companies that we think can grow when we're investing. That way, we're not just worried about what Wall Street thinks in the moment if we're invested in companies that we really think are going to move long term. A lot of times people just need to zoom out on the chart a little bit. People are focused on what happened in the last 2 weeks. And what we need to do is when things are a little tough, Let's zoom out and see, hey, we're still up 40% over the last however many years, because that lends perspective to the situation. And if you're only focused on what's happening today and yesterday and tomorrow, it can be quite an emotional ride.
Jake, if someone is listening today, they want to know whether their retirement plan could survive whatever comes next. What questions should they be asking themselves?
Sure. Yeah. I think you hear experts talking about, hey, have you stress tested your portfolio lately? You need this great bell curve thing that we have here, and we need to do this analysis, and it's very technical. And while some of that's true, it's a lot more basic than that. Here's some questions you can ask. Okay, if in my current strategy, if inflation stays elevated, what's going to happen to me? Am I making enough money to outpace that? Am I going to be okay? If interest rates stay higher for longer, how is that going to affect me? If the market were to go down 20%, am I going to get obliterated? If healthcare costs continue to rise, am I accounting for that? If taxes were to increase, how is that going to affect my portfolio? If my spouse passes away, how is that going to affect me? There's a lot of different things to think about, but it's really those basic questions. And it's okay if you don't necessarily know the answer to those questions, because chances are, if you're listening to my show, you're probably not an investment expert, because you're listening to gather little tidbits of information here and there. And if you are an investment expert, then more power to you. But as we're thinking about this, that's what I'm here for. So if you are unable to answer those questions about your current situation, come in here and sit down with me, and we'll look at everything, and we'll say, hey, here's where we're exposed. Here's what we're doing right. Here's some changes we might need to make. Sometimes people come in and they show me what they're doing. I'm like, no notes. Perfect. Good job. That doesn't happen super often, but it's happened definitely multiple times in the last couple of years here, where people come in. I'm like, wow, I don't have anything that I would criticize here. I like what you're doing here. And I might have a few other tips, but not everybody that comes in, I say, hey, we just need to turn this whole thing on its head and get rid of it. So if you're not looking to have your apple cart upset, that's fine. That's not my goal. My goal is just to try to bring value and help improve your situation.
Jake, these reports remind us that the economy is always changing. If someone wants to know whether their retirement plan is prepared for whatever comes next, how can you here at Floyd Financial Group help them?
Jeff, so having a plan that can weather any type of financial weather and any storm that's coming our way is really the key. If your plan only accounts for the market going straight up, then when the market stops doing that, you're going to be disappointed. If your plan accounts for having interest rates at 4 or 5% and riding CDs into the sunset, then when interest rates come down, you're going to be disappointed. And I think having a plan that really covers the different needs that you have, but also does not get destroyed in any kind of financial weather, that's really the key. And that's not a one-size-fits-all thing. It's not a buy an annuity and ride it into the sunset. It's not let's throw all this money in the market at the wall and see what happens. We need to really be thoughtful about that. We need to include what's important to you, what you plan to do in retirement, and how much you're planning to spend if you want to travel, if you want to go fishing, whatever is important to you. And then we work the plan around that to make those things happen.
Jake, great conversation here. I want to talk to our listeners for just a moment. Every week the headlines change, but your retirement plan shouldn't have to. At Floyd Financial Group, we help families build retirement plans designed to weather changing markets, inflation, taxes, and interest rates, not just today's headlines. So if you'd like a second opinion on your current plan or you don't yet have a written retirement strategy, we'd like to help you out here. Call us today. 417-889-7233 is the number. I know you're listening to us on Saturday. You can call that number, leave your name and number, and Ashley will call you back during the week and set up that appointment for you. No cost, no obligation, and no judgment, of course. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, time for another break. When we come back, we'll be talking about the final 5 years before retirement, the most important countdown of your financial life. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about the final 5 years before retirement. What's most important?
And Jake, a lot of people spend decades saving for retirement, but I've heard you say that the last 5 years before retirement can be the most important years of all. Why is that?
The timing of retirement is important. And as we get closer to retirement, the big thing we need to do is make sure that we don't have a big meltdown right in those last few years before retirement. So if you've done a good job accumulating money through your working years and you've accumulated and you've earned good money, what we don't want to do is have a big drop at a poor timing that's going to prevent you from retiring or alter your retirement. And so starting that planning process about 5 years before retirement is a good idea. We may want to think about introducing a little safety and just look at your overall plan so that while you're still working in those 5 years too, if we need to make any tweaks, if we need to save a little bit more money, if we need to adjust things, there's still time to do it.
And of course, when we start working, that is when we want to think about retirement. Most people do not do that, but I think that they should have that in the back of their mind. Certainly, that's why we have 401ks. And you may invest and you may think about retirement for 30 years, but the last 5 years gives you an opportunity to really take a look at what you've got and make any changes if you possibly need to do that. A lot of people think they know whether they're ready for retirement by simply looking at their 401k balance. Is that enough?
Well, your 401k balance is very important, but it is certainly not the only thing that matters. We need to really look at your situation, what you're wanting to do in retirement, how you're wanting to do it, what you're wanting to spend and when. And then we need to factor in your other income sources like Social Security or pensions or whatever. And then we can factor in how much money is reasonable to pull out of that 401k and not risk running out of money. So your balance is important, but it's not as important as the overall plan and trying to reverse engineer how we get you to where you want to be.
Jake, a lot of people think they need $1 million for retirement. We've seen it in the media, but that is not accurate, is it? Especially here in the last batch of sanity.
Well, I have some people that need a lot more than that, depending on the lifestyle they're used to living, right? But I think in the last bastion of sanity, as you've said here, no, I don't think the average person needs $1 million to retire. A lot of it comes down to the lifestyle that you're used to living. And some people just can't wait to retire and they're 58 or whatever. And they're like, I can cut back spending if I don't have to go to work. And then I have other people that have way more money than they need saved. And they're like, I think I'm going to keep working a little bit longer. I want to make sure I don't lose my sense of identity. And I like the camaraderie. The comradeship, as one guy said. That's actually a word, by the way. Somebody said that to me once.
Comradeship.
Yeah, and I was like, that can't be a word, So I went and looked it up, and sure enough,
it was a word.
Anyway, the camaraderie around the water cooler and stuff at work, some people miss that if they're gone, and they need that social interaction. Otherwise, they won't get any. So there's a lot of reasons that people do what they do. But as far as needing $1 million, you don't need $1 million. There's a lot of conjecture around that. You probably need to have some savings to retire because most people aren't going to be able to do it on Social Security alone unless you're incredibly frugal, which I know a couple of people just winked at their spouse when I said that. Being frugal in this area in a lot of ways is a badge of honor. So Here's to you, frugal people. But I think that having a little bit of a nest egg is good, but definitely don't need $1 million.
Jake, if someone discovers with only 5 years left for retirement that they are behind the curve a little bit, is there still time to improve their situation in just 5 short years?
That's one of the biggest reasons why we encourage you coming to see us in 5 years is, yes, you can make up quite a bit of lost ground in that 5 years. Now, time is not on your side, and, it may not be the most comfortable thing ever, but it's better than running out of money when you're 65. So if you come in and you say, hey, here's where I'm at, here's where I want to be, and we say, hey, well, we're a little bit short of that. Let's buckle down. Let's fund a little extra money. I do think this next 5 years is a great 5 years to catch up. I think that we're going to have quite a lot of growth to be had here. So getting that money in there and getting it ready to grow for you so it'll be there for retirement, this next 5 years is going to be very good.
So, Jake, one of the big questions that people have 5 years before retirement is, when should I take Social Security? A lot of people take it at 62. Actually, that is the most popular age to take it statistically, but it isn't the best age for everyone to take Social Security. Can you comment a little bit on how we decide when we should take Social Security?
Sure. So I have a little bit more simplistic view on this than a lot of advisors. And it's important that I say this is not advice, blanket advice for people to take and just run and go do right now. But each situation's a little different. If you're still working and you go to file Social Security at 62, you're only allowed to make a little less than $25,000 a year without having to pay back some of your Social Security. So it rarely makes sense to turn on Social Security if you're still working. However, if we look at break-even analysis of, let's say, filing at 62 versus at 67, you're going to have to be 78, 79 years old to break even, meaning if you had those payments for 5 years, how long does it take to get even with the higher payment coming later? But that assumes a 0% rate of return. So if we even say, hey, we took that money and put it on 5% interest, now you got to be 95 to get even. So here's the short version that will apply to 90% of people, in my opinion. If you are retired and you're done working, and no matter what age you are, I would probably turn on Social Security. Again, 90% of people fall in this category, not 100%. There's some other factors. If you are still working and you're between 62 and 67, it probably doesn't make sense to turn it on because you're likely making more than $25,000 a year. Once you get to 67, in my opinion, you should probably turn it on no matter what. And the reason for that is you are no longer penalized to be working still, and we want to start getting those payments in. There's a few other factors that come in here that are a little bit unique to the times that we live in. If Congress decides at some point that they want to cut Social Security, and I want to make it clear that that is not my base case, I don't think Congress is going to try to cut Social Security, but if they did and you have already filed, there's a chance that you would be grandfathered in. So that's another reason to turn a little feather in the cap of turning it on earlier rather than later. There used to be like a million different ways to file, literally, for Social Security, where you would file and restrict and file on your spouse and have them suspend and all that kind of stuff. A lot of that stuff has gone away, so it's a little more simplistic now. But basically, if you are retired, most of the time I'm going to advise you to go ahead and turn it on because we want to spend the government's money, not your money. That gives you the most options. And then if you're 67, we probably turn it on no matter what. The only exception to that is if you have a spouse and that spouse maybe was never worked outside the home and you're trying to protect that person in the event you pass away, it could make sense to wait till 70 to really balloon that payment as much as possible if you don't have a lot saved. But realistically, most of the time it's going to make sense to turn it on by 67, whether you're working or not.
And Jake, many people do not realize that when you take Social Security can affect your taxes. And people don't realize that Social Security is indeed taxed. Can you explain how much tax that we might have to pay on Social Security, or how much of Social Security is actually taxed?
Social Security can either be taxed at 0%, 50%, or 85%. Now, when I'm saying it's taxed at that rate, meaning that's how much of it is taxable, not how much the tax is. Some people are like, 85% tax. No. That's how much goes in to figure your income. There's different thresholds that you meet, and if you make a certain amount of money, then it becomes taxable at 50%, and then if you exceed another threshold, it's 85% taxable. There's also something that people aren't aware of is if you are before 65 and you're on Obamacare, there's this thing called a subsidy that goes into figuring how much your health insurance costs. The more money you make, the more you have to pay for Obamacare. It's also true, but to a lesser extent, there's this thing called IRMA that kicks in on Medicare. If you're on Medicare, your Medicare Part B premiums can go up if you make too much money in a single year. There's a little bit of a delay, but then it kicks up. Most people are paying $205 a month for that. It can go all the way up in the $600 a month range for both spouses if you make over certain thresholds of money, and we don't have time to go into all that. But before you make any big moves or you sell a big property with a big capital gain or something like that, it's probably something we should talk about just to make sure you're understanding the full ramifications, not only what it's going to do to your Social Security, also what it's going to do to your health insurance, your tax brackets. And if we have property specifically, we did get rid of the Missouri state capital gains tax. Last week, we voted on the other taxes and that kind of thing, but the capital gains tax has been gone since last year, so that's helpful. But we still want to make sure we understand the whole picture before we make any really big moves like that.
Talking with Jake Floyd of Floyd Financial Group. Our show, of course, is called Show Me the Money, and our phone number 417-889-7233. We're talking about the last 5 years before retirement and some things that you should consider. People often say that they'll spend less in retirement, Jake. I think the last 5 years in retirement, taking a look at what you spend, can be eye-opening. Is it always true that people will spend less in retirement?
Definitely not. I will say that that's probably more true in this area, though, than it is in any other area of the country because people are pretty conservative. I would say that the average person has a little less to live on, but they really have no trouble making it because they stop funding their retirement plans and all that kind of thing. I would say on average, we probably spend slightly more in retirement, but because you have your 401k money sitting there and everything, you should be good to go. And as we think about retirement, right? Let's say you retire at 65. A lot of times in this profession, we think about the 4% rule or the 5% rule, meaning if we withdraw 5% or less of the account, then we shouldn't run out of money as long as we're earning a good interest rate. Obviously, if we earn zero at 5% withdrawal per year, that means it would last 20 years, right? And not everybody's going to live to 85. So as we're looking at all this, we want to make sure that we're sure that we have a 99.9% chance of not running out of money. So when we're looking at how much we're going to spend in retirement, we really need to take an honest look at what we're going to spend, what's important to you, what we're going to do, and how that's going to affect your balances. We want to make sure we're not sugarcoating it for ourselves. If you're a guy that likes expensive things and likes to travel and that kind of thing, we have to be careful that we don't overestimate how little we're going to spend.
Jake, two of the most expensive things that we'll have in retirement, of course, taxes, but the other is going to be health care. So 5 years before retirement, let's talk about that. How do we cover that gap before Medicare kicks in?
Yeah, so a lot of people that are retiring at 62, that's the biggest challenge they face. There's a lot of people that are waiting till 65 specifically because of health insurance. And when we're thinking about health care and health insurance, Mr. Obama did a bang-up job of rat-holing us into basically only having Obamacare as our option. There's some other cost-sharing programs out there like Medishare and the like, but realistically, from an actual health insurance standpoint, he made it so there's no real options out there. So understanding how your income is going to factor into how much you pay for health insurance is important, because the raw cost of Obamacare is outrageous. Even like for a gold plan, it's something like $2,700 a month for a couple that's close to 65. And so if you make under a certain threshold of money, then you get a subsidy where the government says, hey, we're going to make it cost less. If you make under like $30,000 a year, it can be free even for some of the lesser plans. So talking to an expert that understands that situation, that's not my bailiwick, but I know people that do that I can get you in touch with. But understanding how much you're going to have to pay for that health insurance is a big factor as you go into retirement.
The 5 years before retirement, that's what we're talking about with Jake Floyd here, and why it is so important. If you're within 5 years of retirement, this is a time to make sure that every piece of your financial picture is working together. Floyd Financial Group, Jake and the team here, is helping families build comprehensive retirement income plans designed to address investments, taxes, Social Security, healthcare costs, and long-term financial security. Don't leave one of the biggest decisions of your life to chance. Call us here at Floyd Financial Group, 417-889-7233, and schedule your complimentary retirement strategy session. Once again, the number is 417-889-7233, or you can visit us online at FloydFinancialGroup.com and take the first step towards retiring with confidence. Take time for another break. When we come back, we're going to be talking about turning your retirement savings into a paycheck that you can outlive when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we've been talking a lot about retirement income, so let's talk about how to turn your retirement savings into a paycheck that you can't outlive.
That's right, Jake, and if you've been listening to this show for very long, you've probably heard us talk about one question more than any other, and that is creating a retirement paycheck. Now, when you retire, the paycheck's coming from you. You are the employer. And it sounds a little backwards. Most people think that saving is the hard part, Jake, but that's not exactly it, is it?
No, I would say for most people, they kind of set it and forget it when they're saving money, and they have it deducted from their paycheck, and then they wake up 30 years later and have a pile of money there. That's been my experience over the last 21 years of being here, is that's pretty much how people do it. That's how they look at it. I think that it's much harder to understand what's okay to spend and what's not okay to spend, and keep yourself in line as you go through retirement when your earnings days are over, because you can't go back and fix it. And so being careful about how we spend money, when we spend money, what we spend it on is a big part of what I do here. And for a lot of my clients, I'm a sounding board where they say, hey, I need to buy a new truck. Should I pay cash for that? Should I take it out of my retirement savings and pay a bunch of taxes? And so generally the answer is no on that one because I don't like taxes. Should we finance the truck? Should we buy a 1-year-old truck used and finance it at 6%, or should we buy a new truck and finance it at 0%? All these types of questions, and that's just for a truck. The same thing applies to houses or other big purchases and things like that. So I'm here for a sounding board for my clients on those types of issues. But again, understanding how all that's going to affect you and making sure that you don't run out is probably the hardest, but also the most important part of retirement.
So, Jake, let's get down to the basics here. I come to you and I say, Jake, I'm retiring. I need to create a paycheck. The only source of this paycheck is going to be the money that I have in my 401k. You take a look at the 401k, you see where it's invested. What is the first step towards creating that paycheck?
Yeah, so the first thing we got to do is get together and understand how much you're going to need to be pulling out of there to live on. A lot of that's going to dictate what types of investments we might use. Now, if you have it in a 401k now, you don't necessarily have to move it out of that 401k, and you can have them send you distributions, although most times it will be much easier if we roll that money out of a 401k and get it somewhere where you can get your hands on it a little bit easier, and they're not going to charge you a distribution fee of $40 or $50 every time you take money out. So we would assess how much money you need to take out, how much money you have, and then, again, all the things we've been talking about on the show, what's important to you and that kind of thing. And then we set that money up in the investments. Then we set up a direct deposit to your bank account. So we establish a link. We send Uncle Sam his share before it goes to you generally, because if we're talking about retirement money, it's money that's usually pre-tax. So if we need to send money to the government, we do that before it gets to you. That way you don't have to send quarterly payments and that kind of thing. And it just kind of shows up like a paycheck.
So every 2 weeks, every month, every week, can you design the paycheck the way that the client wants it?
Absolutely. Any of those is fine. I will say that most people just go with monthly because they don't want to have to do bills more than once a month.
Right.
So usually we set it up for the first of the month. But yes, we can do weekly. We can do all that kind of thing if it's important to you. But I would say most people fare better understanding they're going to get one deposit a month, pay the bills, and then they can see exactly what they're going to have left over versus like a weekly paycheck. You have to save it for 3 weeks and then make your truck payment or whatever. I think that's a little bit harder to deal with, but whatever you guys want to do is okay.
So, Jake, money's in a 401k. As you said many times, you do transfer that into an IRA because it gives you a lot more choices. If some of that money is in the market and the market fluctuates, sequence of return risk is what I'm talking about here, can that dramatically affect what you're going to get in your paycheck?
So in most cases, the answer is yes. I will say that when I set up my plans, though, I do not ever plan on a client taking a pay cut for any reason. So when I'm looking at setting up a plan, we're going to be conservative enough so that if the market's really going down a lot, we're not going to call you and say, hey, we're not going to send you your income. You don't want to sacrifice your lifestyle based on the ebb and flow of the market. So the plans that I set up are not going to fluctuate that way. If you just throw all your money in the market and kind of hope for the best, you will probably find yourself doing that, though. And so what most people want, and again, this is not all people, but most people, what they want to do is turn their money over to somebody who's going to make sure that it's taken care of and is trying to earn them a good rate of return, but also going to make sure that they don't run out of money. And as long as you can satisfy those things, most people are pretty happy. And I think that most people don't want to become an investment expert in retirement, especially if they've never been in that field before. It's very overwhelming. So that's generally how it goes.
Jake, when people are working, generally almost every year, they'll get a little raise. It might be cost of living. It might be a little bit more than that. Can you build a cost of living increase, or do you regularly do that in someone's paycheck?
Yeah, we absolutely can do that. It kind of depends on the person, whether they want that to happen or not. Some people just want to have it stay the same, and then if they need to take a little extra, they take a little extra. But yeah, if you want to have a cost of living adjustment built in, that's great. When I build plans, regardless of whether we actually do a cost of living adjustment, I build the plan with the idea that we are going to increase income over time because it's going to take more to live later than it does today. So my withdrawal structure, the investments, all of that's positioned around the fact that we're going to need a little bit more money each year than we did the previous year. Some people take a raise every 2 or 3 years or something like that, but generally speaking, it happens kind of organically. We meet with clients every 90, 180 days and say, okay, how's it going? How are things feeling? And usually people will, from time to time, say, things are getting a little tight. I think I need a little more income. So we turn up the income a little bit. That's generally how it goes instead of making it automated. I meet with my clients quite a bit more often than most advisors do. So I think that's why that works for me and my people here. But I do think that's important to make sure that inflation is thought about, because while I don't think inflation will continue to run as hot as it has over the last 6 years or so, I do think there will be some cost of living adjustment required in retirement.
So, Jake, when most people get into retirement, we're really guessing as to how long we're going to live. You've had people say, well, nobody in my family lived to be older than 75 years of age, and then they end up being 95. Longevity is increasing tremendously these days. How do you account for a long lifespan when you're creating a paycheck that's got to last as long as they do?
Yeah, especially if they're like your aunt at 108.
Right.
So I think, generally speaking, my number that I look at is about 95 years old. That's the number that I tend to focus on. And we want to make sure that I really don't even want to go backwards before 95, meaning I want you to go into retirement, invest the money, take your income, and leave you as good or even better than we found you when you're 95. Now, some of that's going to be on you and how many extra withdrawals you're taking, right? So if we set you up on 5% income, how many times you come in after that and say, hey, I want a little bit more money for this or a little more money for this. You can definitely do that, but it will affect the outcome long term. But generally speaking, we got a 99% chance. Nothing's a 100% chance. Anybody tells you that anything's for sure in this life is a liar or a salesman or both. And so if we have a 99% chance of not running out of money at 95, that's generally how I build it. I have people that are older than that, but a lot of the people that are that age, they're ending up with more money, not less, when they get to that point.
Jake, life tends to happen to people. Things go wrong with a house, or maybe, as you said, you need a new car and a big expense comes up. How do we factor that into a retirement paycheck? Is there sort of like a slush fund or a bonus fund that's sitting over there on the side?
So I generally don't separate the money out, but as I build the plan, I have a certain amount of excess built into that plan. Because truth be told, if we started setting up a monthly withdrawal of 7 or 8%, and then you started coming in there and adding more money in there, then we're going to be in trouble. If we set it up at 4 or 5% income, and occasionally you have some additional expense, some of that's going to be dependent on how we set up the investments, how much risk you're comfortable with, and that kind of thing. But there's going to be excess in there for you to pull from time to time. And so I really encourage my people to come talk to me as they're going to make these big purchases. First of all, they're going to talk to me anyway because they need to get the money out, right? But if we sit down and talk about it to make sure that if we ever get too far over our skis, we have too big of spending habit, that we can talk through that and make sure that you understand. I'm never going to tell you can't have your money under any circumstances. It's your money. You can do exactly what you want with it. But I just want to make sure you understand the consequences of the spending you're doing.
Jake, when people are working, they get a certain amount of money that they live on, and hopefully there's a little bit left so that they can save and invest it. Is this something that people generally want to do, or should they do, or do they have to do in retirement with their paycheck, is maybe leave 10 or 15% out to invest further?
Yeah, so I do have people that are wanting to save in retirement, which is not what we're trying to do. Rather than saving retirement income, meaning pulling the money out, paying taxes on it, and then reinvesting it afterwards, what I'd rather do is just not take so much income so that we can skip the tax part and kick that down the road and earn money on the money that we otherwise would have paid in taxes. But yes, in conservative America, I do have quite a few people that are like, well, this is great. I need to have all this money, but then I need to have enough money to keep saving. This is what we saved for. It's now harvest season. It's not saving season after you get retired. Sometimes I have to coach people through that a little bit, but a good saver is not a bad thing. And sometimes old habits die hard.
Right. We planted the corn. It is now time to harvest it. We don't need to plant any more corn because we're not farmers anymore. Jake, if someone is listening today and they're wondering whether they're financially ready to retire, what is the first step?
You need to probably sit down with a professional. That's what I do here, is sit down and talk about retirement plans, help set up retirement plans, help people navigate retirement. And if you're thinking you're close to that point or you're within a few years of that point, it'd be a good idea to sit down and go, okay, here's where I am now. Here's what I think we're going to want to do in retirement. Here's when I think I want to retire. And that's the building blocks of the plan, and we can go through and set the plan up. And then even if we're not doing any business right away because you're still working and all that kind of thing, we can still get all the things in place so that it makes your retirement date much smoother versus if you come in and say, hey, I retired last week, I need income out of my 401k. Sometimes it's a little bit more of a mad dash and a white knuckle ride trying to get all the paperwork done and get all the money going so that you don't bounce your first check in a couple of weeks, kind of a thing. So if you can come in a little bit before that, I think you'll be more happy with your results.
Talking with Jake Floyd, Floyd Financial Group, we've been talking about turning your 401k or your IRA into a retirement paycheck that you can't outlive. One of the biggest mistakes that people make is spending years building their retirement savings, but never creating a plan for turning those savings into a reliable retirement income paycheck. So if you'd like to know whether or not your retirement paycheck is built to last, schedule your complimentary retirement strategy meeting with Jake Floyd here at Floyd Financial Group. He'll help you understand your income options, evaluate your tax strategy, and determine whether your retirement plan is designed to last for the long haul. Our phone number here, 417-889-7233. It's 417-889-7233. Get started on this casual conversation by calling that number. You can also find out more about us online at floydfinancialgroup.com. Retirement isn't just about accumulating money. It's about knowing how to make it last for the rest of your life. Well, Jake, we're out of time for this week, unfortunately. I want to thank you for your time, but most importantly, I want to thank our great listeners here in the greater Springfield area for joining us. So for Jake Floyd, I'm Jeff Shade, wishing you a great August weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.